Empire Architects. This is the story of George Soros. A philosophy student from Budapest built one of the most profitable global macro funds in history by making a decision most traders never formalized. Treat markets as reflexive feedback loops. When policy and prices drift apart, build a position that benefits from the snapback. Then manage downside in real time and press only when the asymmetry is real. That decision turned theory into a trading machine and financed one of the largest private philanthropic networks in the world. George Soros was born in 1930 in Budapest, Hungary. According to Encyclopaedia Britannica, his family survived the Nazi occupation with documents that concealed their identity, and his father taught him to read uncertainty as a practical skill. After the war, Soros left Hungary in 1947 and moved to London. He worked odd jobs while studying at the London School of Economics. There he encountered the ideas of philosopher Karl Popper. Popper argued for fallibilism. Knowledge is provisional and subject to correction. Soros absorbed this and later formalized his own theory for markets called reflexivity. Prices shape fundamentals, not only the other way around. That idea would become a trading edge. He graduated from the LSE and entered the City of London in junior roles. The glamour was not immediate. He wrote letters to merchant banks and sold goods as a traveling salesman before a brokerage seat opened. In 1956 he moved to New York. According to Britannica, he joined FM Mayer as an arbitrage trader focused on European securities. He learned to see cross-border mispricings. He moved to Wertheim and then to Arnault and S. Bleichroder. He met Jim Rogers. He learned that a portfolio could be built around a single view of the world if the risk was managed and the view was updated fast. In 1969 he launched his first fund, Double Eagle, using an offshore structure that fit the global strategy he wanted to run. In 1973 he formed Soros Fund Management and created the Quantum Fund. According to Britannica and historical fund profiles, Soros managed Quantum with Jim Rogers in the early years. The name signaled range. The fund could move in currencies, bonds, equities, and commodities. It could go long or short. It could use leverage when the asymmetry was real. The method was not random. It was an operating system built around reflexivity. The leap moment was the choice to put reflexivity to work in position sizing and in timing. Most traders expressed opinions about value. Soros decided to express opinions about feedback loops. If the dollar rises, capital flows into the United States and drives rates or growth in ways that justify the rise for a time. If a currency is pegged too high, the peg attracts capital that pushes domestic credit higher and the economy weaker. Policy defends the peg and tightens rates that hurt growth. The peg then breaks under its own logic. Reflexivity says prices and policy can create their own undoing. The game is to time the break. But that is not the full picture. He paired the idea with a process. He kept positions elastic. He supervised risk daily. He cut losses. He pressed winners when the market confirmed the thesis. He changed his mind when facts changed. Reflexivity was not an excuse to ignore reality. It was a model for how reality shifts under the weight of belief. The first wins came from the 1970s and 1980s currency and macro cycles. The dollar moved hard. Commodities were volatile. Policy makers adjusted. Soros built positions where the policy response created fresh asymmetry. As the 1980s opened, he ran global equities and fixed income around policy arcs. He saw the importance of the Plaza Accord in 1985, when the United States and major allies agreed to weaken the dollar. According to contemporary financial press and economic histories, the dollar fell sharply after the accord. For a reflexivity trader, coordinated policy changed the loop. The view could be expressed across currencies and in equity markets that would respond to a weaker dollar and to the export gains that would follow. He built Quantum into a world stage presence with performance that attracted headlines and copycats. LCH Investments, which tracks hedge fund managers by cumulative profits, has reported for years that Soros Fund Management ranks among the top in history for gains generated for investors since inception. In recent tallies, those lifetime gains have been reported in the tens of billions of dollars, a signal of compounding carried across decades. The point is not the exact number. The point is the endurance of a pattern. Take a view. Size it when the feedback loop is running your way. Exit when the loop changes. The pattern created pressure inside the team. Reflexivity is not a script. It is a belief that the script can change mid-scene. Soros had to build a shop that could change in hours. He had to recruit managers who could contribute without freezing when risk moved. He needed a risk obsession that was humane but strict. The firm's culture became famous for daily accountability. A position was never owned. It was borrowed from the person the market would next educate. What happened next surprised everyone. The theory met a peg with a flag. In the early 1990s, European countries tried to hold their exchange rates within a narrow band. The policy was called the exchange rate mechanism. The United Kingdom joined at a rate that many economists and traders thought was too high for its domestic conditions. Inflation and output were not coupling with Germany's numbers. The German Bundesbank fought inflation with high rates. The United Kingdom needed lower rates for growth. To defend the pound inside the band, the Bank of England had to keep rates higher than the economy wanted. The logic was reflexive. The longer the defense, the weaker the domestic economy, and the less plausible the peg. Soros and the Quantum team built a short position in the pound. They borrowed pounds and sold them for other currencies. They used derivatives to amplify exposure. According to the New York Times and Encyclopedia Britannica, on September 16, 1992, the day known as Black Wednesday, the United Kingdom left the band and the pound fell. Reports from that week state that Soros's funds profited by about $1 billion on the move. The fund's profits for the year were higher. The outcome cemented a reputation that would never leave him. He was called the man who broke the Bank of England, a phrase that compresses a complex political and market process into a nickname. Here is what most people miss: the trade did not break the pound. The policy logic did. The fund's position made money because the defense required by the policy had become inconsistent with the economy. Reflexivity says beliefs can break facts until facts break beliefs. The trade was not only a short. It was a bet on that break. Winning at that scale brought two shadows. One was praise that turned trading into myth. The other was blame that turned trading into villainy. Soros and his team were accused in later crises of attacking currencies or harming nations. The public conversation was heated. The record in many cases shows that local policy mistakes and credit conditions created fragility. Traders bet on breaks that were already forming. Even so, the public perception stuck. The empire builder would carry both the results and the backlash for decades. Pressure built again in other cycles. In 1994, global bond markets convulsed when the Federal Reserve raised rates faster than many expected. Soros's shop adapted through losses and gains that year. In 1997, the Asian financial crisis erupted after years of fixed exchange rates and short-term foreign currency debt left several countries exposed. Soros was criticized by officials in some countries. He responded in interviews that his fund did not cause the crisis and that he had warned of fragilities. The public debate never quite cooled. Then came 1998. Russia defaulted on domestic debt and devalued the ruble. Hedge funds that carried leverage against supposedly safe trades saw those trades go the wrong way at the same time. Liquidity dried up. Long-term capital management, a large fund that deployed leverage against convergence trades, collapsed. As reported by Bloomberg and other outlets, Soros's quantum fund lost heavily in 1998, with losses reported in the billions across positions that were caught in the crossfire. The reflexivity framework had to absorb pain. The lesson was familiar and hard. Liquidity disappears when many players are long the same risk and need the same exit. The next day can be a very long time away. The crisis did not end the machine. It reconfigured it. Soros began to step back from day-to-day risk. He installed new lead traders and portfolio managers. He kept the system alive without demanding that his view be the only view. He also began to shift more energy toward the other empire he had been building since the 1980s. A philanthropic network that would invest in open society institutions across dozens of countries. According to the Open Society Foundations, Soros began making grants in Eastern Europe in the late 1970s and 1980s and later founded open society entities across the region after the fall of the Berlin Wall. OSF states that Soros and his foundations have committed more than $30 billion since inception to programs in education, justice, public health, and civil society. The number reported by OSF has moved over time as grants have continued. The point is scale and structure. The grants moved through national foundations with boards and staff who set local priorities inside broad values. The method mirrored the fund. Decentralize execution. Keep a clear view of purpose. Adjust when data says the tactic is wrong. As reported by Bloomberg and The Wall Street Journal, Soros Fund Management returned outside investor money in 2011 and became a family office. The firm continued to manage the Soros family capital and to allocate across public and private markets. The family office structure reduced regulatory reporting requirements compared to a hedge fund that manages external capital. The shift matched the founder's stage and the family's long horizon. The emperor's second act was not only grants. It included endowments and vehicles that could pay for long campaigns without depending on any single market cycle. The idea was reflexive in a different way. If the foundation wants to support an independent university or a public health program, it needs capital that outlives donors and outlives politics. Soros used fund profits to create that capital. The Open Society Foundations became a permanent player in rooms where policy and practice meet. But that is not the full picture. The man remained a market thinker. He wrote books on reflexivity in markets and politics. He explained how his back pain sometimes signaled to him that a position was wrong, a human way to say that stress and doubt are part of a process. He emphasized that fallibility is constant. The logic does not say he is always right. It says the market and the trader are in a loop that must be navigated with humility. For empire building, his core decision can be named simply the reflexivity macro decision. Build a fund architecture that can express a view about the feedback loops between prices and policy. Accept that fundamentals are not fixed. Accept that rate paths and credit conditions change because prices move. Then structure a risk process that updates beliefs without ego. That decision allowed the quantum fund to act when the world moved. It allowed the fund to stand down when the world said no to see why this worked, examine the friction he chose to control. Global macro trades suffer from crowding and policy surprise. Many managers follow a narrative that has moved from niche to television in a week. Soros tried to stay ahead of that script by studying the self-reinforcing conditions that had not yet made the news. A currency peg can be defended for years if reserves are large and confidence is high. But the cost of defense is visible. High rates hurt growth. Growth disappoints. Reserves leak. The reflexive mechanism makes exit more likely. The right place to take risk is when that mechanism starts to show in data. He did not invent that logic. He wrote it down and treated it like a discipline. Here is what most people miss. The big profits were not only from being right. They were from being right when the world had to change rapidly. A trader can be right for months and make little if the market has no reason to move today. Reflexivity tells you when today might be the day. The framework points to catalysts. Elections. Policy meetings. Intervention. Peg exits. Debt covenants. You do not need perfect prediction. You need a structure that lets you act when asymmetric timing arrives. The opposite is also true. The worst losses in macro come when you are too early at too large a size and your financing disappears before the world admits you were right. Reflexivity properly understood does not argue for maximal leverage. It argues for adaptive leverage. Soros has been quoted across profiles as saying his job was not to be right. It was to survive being wrong. That sentence is the business model of a macro fund that lasts decades. The empire story has a second column of numbers. According to Forbes profiles, Soros's net worth has placed him among the wealthiest individuals for years, with fluctuations tied to market moves and to donations. Forbes has reported that he has transferred large amounts to his foundations, which reduces measured personal wealth while increasing foundation assets. As of recent years, Forbes has also reported on leadership changes at Open Society foundations, including the appointment of his son Alexander Soros to lead the foundation board. The point for our lens is not family news. It is that the fund profits became a pool of long-term capital that supports a separate operating system in philanthropy. The foundations operate like a macro shop for civil society. They underwrite programs that move the needle and stop underwriting when conditions change. They commit for years when a slow build is required. They open and close country programs as politics and need change. The grants are an allocation policy. The reports are risk memos. Open Society publishes annual reports with program descriptions and audited financial statements. The scale is not a rumor. It is a structure. What happened next surprised everyone again. A man famous for a single day's profit became more famous in some circles for the money he gave away. The debates around those grants are heated and beyond our scope. The fact pattern is not. The fund machine financed a grant machine. The reflexivity decision produced both. Return to the market arc to close the business story. Soros fund management continued to allocate through the 2000s and 2010s across macro, equities, credit, and private markets. The shop hired specialists. It invested in technology firms and in private rounds. It kept a macro sensibility. As reported by Bloomberg and other outlets, the family office disclosed stakes in public companies through regulatory filings when required. It also built private portfolios that are less visible by design. The empire today is a family office with a global allocation, paired with a foundation network that operates in more than 100 countries, according to Open Society Foundations. A calm list of lessons emerges for builders who operate far from foreign exchange. First, name the feedback loop in your market. In real estate, listings beget listings when prices rise and lock in when rates rise. In software, user growth changes investor appetite, which changes hiring, which changes product velocity. In food, input prices and menu pricing circle each other. Treat the loop as a system you can trade, not as a paragraph you recite. Second, build elastic risk. A business that cannot reduce exposure during a storm is a business built to drown. Soros sized up when the market confirmed his thesis. He sized down when the market screamed. A firm can adopt the same logic. Make a plan to shrink burn in a week. Make a plan to double output in a month. Write those plans before you need them. Third, watch policy as part of fundamentals. Many operators treat regulation as a surprise. Soros treated it as a variable. Rates, capital controls, taxes, subsidies, and enforcement detail move markets. They also move sectors and startups. Build a lightweight policy map for your domain. Your reflexivity map will be better for it. Fourth, compound into permanence. Soros turned a flow of fund profits into a stock of foundation assets. A family business can turn a flow of product profit into a land portfolio that anchors a future. A studio can turn seasonal revenue into a catalog that pays during quiet months. The play is to convert volatility into something that sleeps. Fifth, hold fallibility as a feature, not a flaw. Soros wrote that error correction is the engine of science and markets. In a company, error correction is the engine of product-market fit. Build culture that admits wrong moves and updates fast. Your compounding rate will rise. It was not luck. The winds arrived across regimes and across instruments. The system survived losses that ended other shops. The founder moved from desk to library and the structure kept working. LCH Investments places Soros high in the all-time profit tables for a reason. The model worked more than once. Modern applicability is straightforward. Reflexivity is present in social media virality, in capital cycles for artificial intelligence investment, in commodity extraction, in housing inventory, and in institutional trust. You can build a business to ride those loops rather than be ridden by them. For the mechanics behind this pattern, the channel's Money video explains the Quadratic Strategy in detail. There is a caution to close. Macro trading at size brings criticism when trades intersect with national pride. Philanthropy at scale brings criticism when grants intersect with political narratives. The lesson is to separate noise from structure. Verify numbers. Decide in daylight. Operate within law. Then let outcomes speak. That is the calm way to build and to give. From a student selling souvenirs in London to the manager of a fund that profited on Black Wednesday and donated billions over decades, the line runs through one decision. Markets are not machines that compute value in silence. They are conversations that change the value they compute. If you understand that, and you build your risk around it, you can turn volatility into a business and a legacy. George Soros built an empire by writing down a simple thought and acting on it with discipline. Prices and policy talk to each other. Listen. Then build your shop to answer in real time. If you enjoyed learning about this empire builder's journey and you're interested in building your own empire, there's something you need to know. George Soros and 78% of the Forbes 400 use a specific strategy to build massive businesses and multiply their wealth systematically. But here is what most people miss: there is a pattern. A strategy hiding in plain sight. The Forbes 400 know it. They exploit it. They have built fortunes with it. And it has been hidden from mainstream business education for decades. First link in the description reveals what the titans of industry do not talk about publicly. Watch it next. 10 minutes that could change everything.